Welcome back to the course Introduction to Commercial Banking and Fintech. And in this course, in the last session, we discussed an interesting topic that how we can play with the income statement of a bank and what our factors play important role. We calculated the pre-tax net income, burden, provision for loan losses, and then we were able to calculate the pre-tax net income. We also superimposed the scenario of monetary and fiscal policy, and we were trying to see that with the tax rate change, how the overall earnings of the particular bank also change, and particular bank changes. And we can also we also saw that when we have the rate of interest change, whether it has been passed on to the customers equally or in a different manner, then there will be a different impact, and we saw that in terms of net income calculation. In this particular session, our focus will be on related indicators, and this will be coming towards the risk side of the bank to some extent. So let's focus on that side. Now we are getting into something called profitability, return on equity and return on assets. So net income we know already, and what is the shareholders equity? So shareholders equity, you can simply think about asset and liabilities, that how much is the difference. And return on assets, equity we know that shareholders equity, that how much the equity held by the shareholders, and that will be difference between what the company is having the market value minus the liabilities, or you can say from the asset side. Return on assets measures the profitability related to total assets. So this will be like how much the company is converting, or if the numerator is higher, it means that the company is more efficient in converting asset into net income. If the net income is lower than the total asset, it means that bank is not efficient enough to convert assets into a net income or interest income in income. So this is where it is very, very important. So higher ROA means that we when we do banking sector or banking studies, we often use these two indicators to measure the profitability. So return on equity may be on the shareholders equity side, but return on asset is a crucial indicator, and what we normally see about the efficiency of the banking sector. So this is where it is very, very important. So net income and shareholders equity basically talks about this. So net income is interest income minus expense. This we have already solved, right? And this is what we called that as a burden, right? And provision for loan losses and taxes. And taxes, when we are going for pre-tax, this will be 0. When we are going for tax adjusted, so this will be this. Shareholder equity we often take in the case of banking, especially not for the non-financial. For financial company, it is becoming a total asset minus total liabilities, because there is no as such product. So banks earn interest income on loan and investments. Bank pay interest expense on deposit and wholesale funding. So this is what, and provision reflect the credit losses on the loans that they are expected, right? So this is what we get. If you want to understand the income statement, so this we have done already, that how it is done. For the sake of your understanding, I have given up here, right? So shareholders equity, if the total asset is this, so shareholder equity is 700, right? Which means that whatever the banks are making the profit, that on that they can, or whatever difference between asset and liabilities, on that equity holders can have the claim, otherwise it will not, right? So this is what we pay, and sometimes this amount that we have calculated here, it is part of the tier 1 and tier 2 capital. I think you'll have to wait for some time to understand in detail. When we will discuss the Basel norms, there these norms will be coming, and then we'll be also discussing those further. Now another related angle is equity multiplier. And what is the equity multiplier? That how much, so equity multiplier, we know that in the case of ROA, we have, so return on equity and return on asset into equity. So return on equity, you can also calculate return on asset, which is net income upon asset, multiplied by the equity multiplier. Equity multiplier is nothing but total assets upon shareholders equity. What is the meaning of it? That how much bank is able to make money and how much bank is able to convert the equity into assets, and this is what we often mention. And if the EM is higher, right? So this is equal signs, right? So this will be also higher. So return on equity, if you have equity multiplier, how quickly you multiply the assets into equity, and if it is higher, your return on equity is going to be higher, because this is what we get in the formula, right, on the ROE, so net income upon shareholders equity. So and we are saying that ROE is nothing but ROA into EM, equity multiplier. So this particular part here, we have a net income upon the shareholders equity. Here we have a net income upon total assets, and here we have the same equity multiplier is the total asset upon shareholder equity, right? Now in this case we are seeing that both of these things are interlinked, but if you have increase in this or increase in this will immediately imply the increase in the return on equity. So it is very, very important to understand. So let's understand with one example. Suppose net income of a bank is 1200 crore and total asset is 30,000 crore, equity is 2500 crore. So this is what we get. So how much are we going to get in terms of return on asset? So return on asset is how much? Net asset, net income upon the total asset. So it is coming out to 4%. Your equity multiplier is how much? It is total asset upon the total asset upon the shareholders equity. So it is 2500. So how much it is? It is 12. So how much you are going to get the return on equity given your asset on return on asset? So this is ROA into EM. So this is coming out to be 48%. So how can you interpret? So a strong profitability on assets, which is 4%, combined with moderate leverage equity multiplier, which is like 12%, it immediately gives the equity holders return on equity 48%, which means that the two important angles are important. If you are investors in the banking stocks, then you have to always keep in mind that it is not just the return on asset, but it is also the equity multiplier that plays important role. And more shareholders equity, it also implies that somewhere it is more leverage kind of setup. So this is what leverage amplifies returns, but must be managed through credit and liquidity risk, because we are getting into more of the shareholders equity. It means that if the company has gone for more of issuing of the stock or any other asset, then it means that the shareholders equity is increasing. So it may happen that it has synced with the market and it has gone up. So it may happen that after some time it will start showing the if it doesn't sync with the market, then this will be a immediate impact. Or it may also happen that because of the total asset, because total asset is the normally the loan accounts, right? So if the total assets are having more losses, more default, then this will further impact your return on equity. So as an investor, if you have more NPA, so during 2016 when we had the Indian banking crisis, we saw that majority of the government banks had a huge amount of losses of NPAs, which means that if the asset size is deteriorating, it means that it will pass on to the equity. So those who are holding the shares of the banks, their income will be impacted. And this was the same case that happened in 2016 when Raghuram Rajan was the governor, that investors were worried, shareholders equity holders were worried that what is happening with the banking system, and their balance sheet is not very accurate. They are not giving the true signal that how much losses they are making. And when it came out, then we found that return on equity was very poor. So this is what we mentioned on leverage and credit and liquidity. So credit link is this, and liquidity linked with net income, that how much you are able to generate, right? So this is what, if your provision for loan loss is higher, then you know that your net income will be impacted. So this is what it implies here. So equity multiplier measures the financial leverage in the banking by comparing total asset to shareholders equity. Higher leverage can amplify return. So this is what we often get, and compute the for both banks. Suppose bank A and bank B we have, and these are the balance sheet indicators. Then we can say that bank A has 10 and bank B has 20. So which means that bank B is more leveraged than bank A, because it is banking more on the asset of that bank, right? higher leverage increase in return on equity, and this is what it implies. And coming to the revised formula that we had for the return on equity, which is return on asset into equity multiplier. So if the bank earned the 5% return on asset, then we can easily see that return on equity is 50%, and for the bank B it is coming out to be 100, which means that the equity multiplier for both bank A and bank B matters, and bank B appears to be converting more asset into equity, and this is where it is leading to this. So even with the same operating performance, bank B delivers a much higher ROE due to higher leverage, because here you have the equity multiplier, and equity multiplier is nothing but total assets upon the shareholders equity. So this is what, so asset quality matters here, and that's why you will see that throughout the regulation we focus more on the asset side, and this is where it is very, very important to understand. Equity multipliers are also, it is something called as the financial leverage. It is also very important, and it has importance because of the credit and liquidity risk that I have highlighted here. They also offer some kind of liquidity buffers in case of any unfortunate incident or shock. Then it also talks about the market discipline and funding cost, which is also further the case. In Basel norms, I am not discussing these things right now, but when we discuss Basel norm, Basel 3, these two terms are very common there. So this is also very easy to use. Now, we have discussed the return on assets, right? So net income upon total assets. Now we are going to see that can we decompose the return on asset. So it can be composed into two. One is the bank's profit margin, how much the bank has the profit margin, and second is the asset utilization. If they are getting deposit of 10,000 rupees, after keeping CRR, SLR, suppose they are left with 9,000 rupees of cash, are they efficiently using for getting more income, which means their asset size is increasing or decreasing. So utilization matters, right? So here we have asset utilization of again interest income that you have upon total asset plus non-interest income upon total asset. So here we have interest income plus non-interest income upon total asset. So this is where when interest rate will rise, the asset utilization rises, and it falls AU when we have the asset utilization falls. So what is the denominator is same. It is just that how much you are able to generate the interest income. If you are able to generate income higher, it means that you are more efficient bank. You are not keeping your asset idle, and lot of time we find that because of this horse racing of asset utilization, lot of companies, they end up lending to the bad borrowers, and they may not be paying back, and they will be defaulting. And because of that reason, we often see that a banking sector never comes out with the NPA mess or the crisis, because of the asset utilization parameter that we have. So it is somewhat controversial in that context. Then here we have the net interest margin and earning based. So net interest margin is nothing but we have the net income. So net interest income divided by the earning asset, how much we have. So net interest expense, here we have minus net interest income upon the total asset. So this is what we often get. So non-interest income upon minus non-interest expense, this we have already solved, right? So OE minus OI upon total assets is called as the burden, if you want to calculate, right? So the bank's earning base, it is also linked with the burden when we divide with the total asset. So earning base is called that how much we have the non-interest expense and non-interest income, and when we divide with the total asset, then it becomes that. So let's have the example. Suppose SBI and ICICI each have the total asset of rupees 20,000 crore. Liabilities they are having is like 18. SBI has 18,500 crore. So asset means the loan account of worth. So they have 20,000 crore. Liabilities they have is the 18,500 crores. ICICI has 19,200 crores. So compute the equity multiplier for both banks. So here it is equity is equal to assets minus liabilities. So equity is how much? Equity multiplier that we know that it is assets upon equity, which is net income. And so how do we calculate? So equity for the first bank, it will be 20,000 asset minus liability, so it is 1500. For ICICI Bank it is 800, right? And we can calculate the equity multiplier. So here we have net income is 20,000 crore upon the shareholders equity is 1500. Here it is 20,000 crore upon 800, it is 25. So here you can see that equity multiplier for ICICI Bank is higher compared to SBI, which means that for ICICI it offers good ROE as compared to the SBI, and this is what it implies here, right? But since it is dealing with the total net income this is dealing with the total asset size. So this is what here we are having. So total asset size, I think I mentioned net income, total asset size, and here also we have the total asset we are seeing, and this we calculated the shareholders equity. So this is what we got it here. So shareholders equity, we calculated asset minus liabilities, right? So asset minus liabilities is this, right? So this we are doing it, and we found that the total asset wise, because it is more sensitive to the numerator, we are seeing that the ICICI Bank looks much riskier because it is banking more on the asset side, and this is where it is very important to look at. Similarly, I think I have given you one more example, you can have a look, right? Now this again I gave for your understanding, so maybe we can move on and we can see now one more angle. So now we can see that how is the balance sheet of a bank looking like. So let's go by that. So here we have the asset side. So in this asset side you can see that we have the cash and due from bank, time deposits at other institutions which they are saving. So this is the asset. So how much is the income earned by the bank? So this is why we are saying in equity multiplier it is riskier. In repo rate that they have investment, so repo rate implies a reverse repo, treasury securities, state government bonds, other bonds like whatever foreign bonds and other locations they have, and other securities also. So these two are subject to government regulations if a public sector, and it is also linked with the central bank decision. So all those equity that they have. If I sum this up from 1 to all, so I have written here. So if you are summing this 4.1 to 4.5, so this will be called as total investment. So for your reference, I have just summed this up here, sum 4.1 to 4.5. Loans and leases that we have commercial individuals, so here it is 18,670. Real estate is 10,740. Consumer is again 1430, and other investment that they are having into real estate and others. So this we can always think about. So here we have the 1430. So if you sum this up 5 to 8, it comes out to be total loans and leases. And if I just subtract for reserve for loan leases, which is very common for losses that they have. So this is like provision for losses that we often include, provision for loan losses. This we included in the net income, right? So it is coming out to be 44,850. If I sum this up 5 plus 8, so it is coming out to be 44,850. And net loans and leases, if I subtract this again, this amount, so it is coming out to be 43,600, right? And if I sum 1 plus 2 plus 3 plus 4.5 that I summed here, and then here I have 8.3, this after adjustment of this, and plus 9 the other asset that the bank has, so it is coming out to be 80,000. And if you see in terms of percentage, so 31.5%. So the maximum amount of share in total asset we are finding this is the core banking, right? So fractional banking we say, so core banking activity. So bank is getting more then 50% from these loan and leases, real estate, consumers, what they are lending to consumers and others, right? And then 31.5% is coming through this total investment. So this is what it implies here. Liabilities and shareholders equity is this. So here it is mentioned about this 1 to 7. So here it is 70,790, and total liabilities is this 72,880. If I sum this up, so 8, 9 plus 10 plus 11. So in this case, let's go one by one. So here we have first is the demand deposit. So liabilities I mentioned and shareholders equity. So demand deposit I have here. You can see interest checking deposits. Interest checking deposits are 9,730. Money market deposit account is 7,970. Regular savings that they have, so it is also 6030. Cost of operations less than 100,000, it is coming out to be 30,560. Cost of operation greater than 100,000, it is coming out to be 7820. Short term borrowing is 470. Subordinated debt, which is like you have given the debt which you are not able to manage, so you have given to you have subordinated. So it is like 1,000 crore, a million in rupee. And then here your other liabilities which could be of any type coming from different sources, maybe from regulations or from individuals, maybe from a special purpose. So those are included here. Then in others we have the shareholders equity. So here we have the common stock, which I was saying that you are holding the stock of the company. Surplus that they have retained earnings, they did not declare the dividend, they retained that earning. So a lot of time there is argument that whether dividend is good or the retained earnings is good. In some cases people say that dividend declaration is good, because when company declares the dividend, it gives the good impact, good impression about the company, that company has earned so much that it has given dividend. But people argue that instead of giving dividend, which is like very minimal amount, and there is a whole lot of literature talking about that the companies which declare dividend, after declaration they see decline in their stock prices, because many people sell the stock and move to the next stock that they were looking for, right? But if you're keeping the dividend in as a retained earning and you add this retained earning in your capex, then it means that you are going to undertake new projects for expansion. This news will lead to more appreciation of the stock price, and that appreciation may be having more earnings to the stockholders than the stakeholders equity than the normal dividend declaration. So in lot of time we often get into that. So this is what it implies. Unrealized gains and losses, it is 120, right? So stockholders equity that here we have, if you sum this up, 2,147,7120 we get here, and if we sum this 12 plus 17, it is coming out to be 80,000. So both the account have to be matched. So 80,000 is coming here. If you see the total deposits side, so here you can see 91.1% you are getting in total liabilities. Out of this, 88.5% has the total deposit share of different types. So this is the core banking we say. Money comes from here and it goes to the assets. So core banking that we have, you can see that it has the 88.5%. Now let's think about the total interest income. What kind of interest income banks have? Then we will be focusing on interest expense, right? And then we will be getting into non-interest. We calculated burden, right? So for burden we will be using it here. So here we have interest on loans, it is 5125. Interest on repos, it is 251. Interest on time deposit, it is 182. Interest on government security, state government bond, it is 1326. Interest on SDLs, it is 521. Interest on other securities, it is 95, and overall it is 7500. So this is what, so you can see what all components are: interest on loan, interest on repos, interest on time deposits. Repos means reverse repo, not the repos at which borrowing, it is income, right? So when you are keeping, and you can also add now SDF, because SDF is also giving uncollateral income to the individuals, right? So this is what we have. Interest on deposit is 182. Interest on government security, state government bond, it is 1326. Interest on SDLs, this is what you have 521, right? So state bond that we have, right? And then here we have the and here we have interest on other security which they invest, so it is coming out to be 7500. Interest expense, you can see the interest on the checking accounts which you have, interest on the regular savings that they are supposed to give, interest on special accounts, female account, there are children account, there are different widow account, senior citizen account. Senior citizen, they are supposed to pay higher rate of interest to the bank, so those are there. Interest on certificate deposits less than this. Certificate deposits again 1 million or less or over 1 million. Interest on deposits, so if you just sum this up, it is coming out to be 4178. Then we are here interest on short borrowing, interest on subordinate debt is, it is 92. Total interest expense is nothing but here we have the 4300, and net interest income is equivalent to what we have, the 3200. Provision for loan losses is 450, and net interest income after provision, if you just subtract this 3200 minus 450, we are getting 2750. So this is what the interest expense of the bank look like. Let's go about the non-interest income. In non-interest income, here you have the service charges that banks often charge, fee income, whatever services that you get. If you are getting for example a special privileged account, you are supposed to pay a maintenance fee. Securities gain, if they have invested in any kind of stocks approved by the government, so then they will be getting other income like leases and other that they get. So total non-interest income is coming out to be 1700. Salaries and employee benefits, these are the expense that we are getting. So an occupancy expense, for example, if they are operating in a particular premise, the rent that they pay, so this is what. Furniture and equipment expense that they have, other operating expense like whatever working related expenses that they get. If you sum this up, you get 2700. Now we have the data. So now we are calculating 25, 26 and 27 are very important. Interest before taxes, we are saying that you add 7 plus 24, 7 plus 24 is this. So interest before taxes, which means that it is talking about total interest income plus the non-interest income minus, here I am summing the 15. So 15 is the total interest expense plus 30, which is the total non-interest expense, plus 17, here we have provision for loan losses. So this comes out to be 1750. Interest income tax expense, suppose it is coming out to be 410, right? So now I can search 1750 minus 410, it is coming out to be 1340, and this is what we call this as net income. Earnings per share, you can just divide this by 1000 or so. So if the shares are 1000, 1340 upon 1000 you divide, it comes out to be 1.34. So this is what. So I hope with these two slides you are able to understand. Maybe in the next session I will recap these things and then I will start. And with this I will be now confidently say that you are able to get the idea about the financial side of a bank or the commercial bank. And I will also give you some more questions related to this in the practice set so that you can practice, and also in the assignment. And I will also mention some of the special cases that you have to look into. So with this I am stopping it here. Thank you so much. I really appreciate your attention and I hope you are enjoying the course. Thanks a lot.